Good day, ma'am, and good day, classmates. Today, we are going to discuss about the sale of Stearns. Stearns was a large investment bank, securities trader, and brokerage firm operating globally with headquarters in New York. The firm had been in operation for almost 85 years when its outsized position in subprime mortgages raised questions from investors, clients, and counterparties about the bank's balance sheet and the quality of its assets. A failed hedge fund sponsored by a subsidiary of the bank in 2007 had brought unwanted questions about subprime loans in general in an increasingly wary market. Bernstein was one of the most highly leveraged firms on the Wall Street. After it collapsed during 2008 financial crisis, Bernstein was ultimately sold to JP Morgan Chase at a fraction of its pre-crisis value.
A firm's management was known to focus on immediate opportunistic returns with a little long-term strategic planning. The Gramm-Leach-Bliley Bill, or GLB, enacted in 1999, allowed financial holding companies to engage in banking, securities, and insurance. Bear Stearns was surprised as part of this voluntary program. In the end of the program was noted to have a number of serious deficiencies and has since been terminated.
Stearns had a history of aggressive market behavior. In the early days, Bear was a heavy investor in equities, taking advantage of the thriving investment climate in the 1920s. Trading fell off sharply in the market construction of the early 1930s, but Bear managed to survive without shrinking the number of staff or eliminating the custom of employee bonuses. Bear Stearns sponsored two hedge funds through its subsidiary, Bear Stearns Asset Management. The main fund, the High-Grade Structured Credit Strategies Fund, was made up of complex derivatives backed by home mortgages. During most of its life, it was highly profitable, but as the housing market began to stutter in late 2006, the returns suffered. This fund was leveraged at 35 times its invested funds.
In June 2007, Bear Stearns pledged a collateralized loan of around $3.2 billion to arrest the deteriorating value of high-grade structured credit strategies fund. It is also negotiating with other lenders to lend additional money to the other fund. Bear Stearns High-Grade Structured Credit Enhanced Leverage Fund. In July, both funds failed as two subprime funds lost nearly all their value and Bear Stearns' reputation was irreparably damaged. The capital it lost came at a time when the firm should have been seeking ways to augment its capital, attract a partner, reduce its large and growing inventory of weak assets, or otherwise stabilize the firm. The hedge funds using these strategies posted massive losses that required them to be bailed out internally, costing the company several billion upfront and then additional billion-dollar losses in write-downs throughout the year. The turmoil saw the first quarterly loss in 80 years for Bear Stearns. Quickly, the rating firms piled on the continued to downgrade Bear Stearns, mortgage-backed securities, and other holdings. Formerly one of the largest investment banks on Wall Street, the collapse of Bear Stearns is now regarded as a cautionary tale against corporate greed and the whims of the free market. Ultimately, Bear Stearns was acquired by JP Morgan in the fire sale, since the purchase was supported by the Federal Reserve. The acquisition raised ethical questions about corporate bailouts and the government's role in a market economy.
This compensation structures encourage greedy risk-taking behavior that normally involves to generate sufficient returns to justify the enormous management and incentive fees. Both of the Stearns troubled funds fell well within this generalization. Unfortunately, the Bear Stearns portfolio managers failed to expect these sorts of price movements and therefore had insufficient credit insurance to protect against these losses because they had leveraged their position substantially. The funds began to experience large losses. The lenders required Bear Stearns to provide additional cash on their loans because the collateral or the subprime bonds was rapidly falling in value. Ultimately, it became public knowledge in the hedge fund community that Bear Stearns was in trouble, and competing funds moved to drive the prices of subprime bonds lower to force Bear Stearns' hand. Simply put, as bonds fell, the fund experiences losses, which cause it to sell more bonds, which lowered the prices of the bonds, which caused them to sell more bonds. It didn't take long before the funds had experienced a complete loss of capital.
After its hedge funds failed in July 2007, Bear Stearns faced more challenges in the second half of the year. Taking out the repo lenders to the high-grade fund brought nearly 1.6 billion in subscribed assets onto Bear's books, contributing to a 1.9 billion write-down on mortgage-related assets in November. The Commission concluded that the failure of the Bear Stearns and its resulting government-assisted rescue were caused by its exposure to risky mortgage assets, its reliance on short-term funding, and its high leverage. This were a result of weak corporate governance and risky management. Its executive and employee compensation system was based largely on return on equity, creating incentives to use excessive leverage and to focus on short-term gains such as annual growth goals.
In the early 2000s, Bear Stearns was among the world's largest investment banks and a highly respected member of all Wall Street pantheon of investment banks. Despite surviving and then thriving after the Great Depression, Bear Stearns was a player in the mortgage meltdown and Great Recession that followed. Bear Stearns operated a wide range of financial services inside this mix, where hedge funds that use enhanced leverage to profit from collateralized debt obligations or CDO and other securities debt markets. The collapse of the housing markets caught the whole financial system by surprise, as much of the system was based upon a foundation of a solid housing market underpinning a solid derivatives market.
So JP Morgan's acquisitions of Bear Stearns was only possible thanks to a 30 billion US dollar guarantee from the Federal Reserve. This bailout raised major questions about the role of the government in the free market economy. Lehman Brothers, a major lender of subprime mortgages. By 2007, Lehman Brothers a mortgage portfolio with 85 US dollar or 4 times its shareholder equity. It was also heavily leveraged, meaning that a relatively minor downturn could wipe out the value of its portfolio. On March 17, 2008, just after the Bernstein bailout, the value of Lehman's stock fell 48%.
The Bear Stearns funds used techniques to further jack up the leverage to those supposed market fundamentals, only to find out at the downside risk on the instrument they were dealing with wasn't limited in this extreme case of a market collapse. The Bear Stearns hedge fund collapse. The hedge funds using the strategies posted massive losses that required them to bail out internally, costing the company several billion upfront and then additional billion-dollar losses in write-downs throughout the year. This was bad news for the Bear Stearns, but the company had a market cap of $20 billion, so the losses were considered unfortunate but manageable.
In this topic, we gather some facts or frequently asked questions about it.
What happened to the Bear Stearns investor after the collapse? As part of the stock swap deal with JP Morgan, Bear Stearns investor received about $10 of JP Morgan stock in exchange for every share that they owned from Bear Stearns. This was a sharp discount from final share price of $30. Had those investors kept those shares, they would have recouped their losses 11 years later, according to the Wall Street Journal. What did the deregulation play in the Bear Stearns collapse? Some economists have attributed the subprime mortgage crisis to financial deregulation, particularly the 1999 repeal of parts of the Glass-Steagall Act. This repeal removed the legal barriers between commercial and investment banking, allowing bankings like Bear Stearns to issue and underwrite securities. These securities would ultimately become a major catalyst for financial collapse.
Who went to jail for the 2008 financial crisis? Although the 2008 financial crisis caused a public outcry, there was no reckoning for the bankers who were blamed for the crisis. Two managers of the Bear Stearns hedge funds were arrested for misleading investors, but they were found not guilty. The only successful prosecution was of Karim Sirajeldin, a credit shoes convicted of mismarking bond prices to hide the bank's losses. Who benefited from the Bear Stearns collapse? While there are no clear winners from the Bear Stearns collapse, stockholders would have suffered arguably greater losses had the bank gone bankrupt. JP Morgan Chase, which acquired Bear Stearns at a fire sale prices, would also benefit, although it would be some time before JP Morgan would break even.